the income aspect of options trading. How would you sort of just describe that and just explain that to someone?
It's good timing you asked me that, because just earlier today I was talking to Seth and then a gentleman, Mike Eisner at SMB. We had a conference call and we were discussing that exact topic, because we want to bring some of our newer options programs that are really based on very, I'm going to call them simple strategies, and it's not because they have a lower probability of success or any other factor that makes them less attractive. They're just simple to understand. And we were just discussing on how do you describe this to somebody that doesn't know the options market. And the idea is the options market is an insurance market if you look at the fundamentals of it. And I'll just describe it also by paralleling the futures market. The futures market is originally designed, and the purpose of it is for hedging. So if you own a bunch of stocks and you want to short-term lock in the price of those stocks, but you don't want to, say you have a basket of 100 stocks, and they're all different places, and let's say this is back in the old days when they were actually stock certificates, and it was a big to-do to go figure out how to sell all your stock because you thought the market was due for a correction, it was crashing, maybe it was up a lot, so you want to hedge. Whatever that circumstance is, the process of selling was so cumbersome that it was easier to go to the futures market and sell a few futures contracts and have a synthetic hedge. You synthetically reduced your exposure to directional conditions in the market. The options market comes a step further and uses a variety of contracts, calls and puts, that you can buy or sell, and then combinations of those. And it basically creates that same hedging opportunity. You can sell calls, which would limit your upside, but it says if the stock or index rises above this price at or before expiration, then I would have the obligation to dispose of this asset at that price to the person that bought the call from me. And then if you buy the put, or if you sell a put, if the market drops below the put contract at or before expiration, then you could be under the obligation to buy the stock or asset at that price from the person that bought the put from you. So, and then you can be on the other end, you can buy. So you'd have the right to execute that contract, but you wouldn't be obligated to do that. So once you get past, that's where the learning curve is. You have to get all of these contracts and long and short puts and calls, premium, buying premium versus selling premium. Once you get through all that, the simpler analogy is it's just like an insurance company. There's the insurer, and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance.